makes sense to get on the train of more heavier value add where you have more deeper margins. You have to build the thing, which is an expertise that a lot of people don't have. It's a matter of bringing in the right professionals and getting up to a large scale to be able to pay the right professionals to do it. So I think that's what one of a misnomer a lot of people have is, development is just pulling the deal together, but it's actually the construction element part. Now that's the hard part.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Lane Kawaoka, welcome to the show.
Hey, thanks for having me, Sam. Aloha, everybody.
Pleasure to have you, man. Welcome to the show from Hawaii. I'm certainly jealous of your location. Sounds like a great place to be here today on this hot day in June. But Lane, I've got 3 questions for you that I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Where did I start? Well, I was a lowly engineer that didn't really like my job, that graduated college in 2007. And I bought a little rental property and bought a bunch of turnkeys after that. And then I started syndications back in 2016. Where I'm at today, currently own over 8,000 rental units, $1.2 billion in assets under ownership, multifamily or workforce multifamily, some hotels, developments, but all under the real estate space that kind of goes under the sort of the recession-proof theory, right? That at the end of the day, this is a commodity, especially if you cater towards the workforce housing sector, which is the glut of the American population that, the need isn't getting any smaller for that. How did I get there? Well, it all kind of starts with the first one, right? Buying that first rental property, then saving your money and for down payments to buy the next one. I eventually got 11 rentals in 2015. And that was when I started to realize, although little rental properties are a great way to get your net worth out of the ground to $500,000, $1 million, it's just not scalable for credit investors beyond. And that was when I started to get into these larger multifamily syndicated projects.
That's fantastic. How did you, having 11 units in 2015, that's 7 years ago. That's pretty meteoric growth in 7 years to go from 11 rental units to 1.2 billion in assets under management. There were some very decisive steps that I feel like you had to take in that 7-year run. What do you feel like were some of those key decisions you made in that process?
Well, part of it's vanity metrics, right? Like we say you own over 8,000 units. I don't personally own them all 100%. I own a fraction of it because we syndicate it out and we bring investors in. But, if you probably do look at the equity, it probably has been an exponential growth. Part of it was just, telling folks what we did. And, we started with buying little Class C crappy properties that were kind of a pain in the butt with difficult tenants. Eventually moved more into buying Class B assets. I still think that's a nice little sweet spot, especially if you buy in the emerging markets such as Phoenix, Houston, Dallas, Huntsville. And then, we started to realize that we were just the entrepreneurs in this game, and we started to hire it out to, property management professionals who've been in the industry over a decade and started to expand the team. And that's how we were able to kind of get, deal done every other month and scale past, 5,000 units or, definitely get over I would say $500 million of assets under ownership is kind of a big step.
Yeah. Was there a point in time when you said, okay, the machine can now kind of self-replicate its own success?
I think there was maybe a big aha moment when you start to hire people under you that know a lot better than you and will always know a lot better than you as the the owner or founder. But I guess that's not a surprise, right? But for some strange reason, I think people in real estate think that, oh, anybody can do this. And on one level, they are right? It's not that difficult. But, just like how, if I just tease one of my doctor friends, hey, I'm going to be a doctor tomorrow, they'll just laugh at me. Just like if, when I was an engineer, hey, I'm just being an engineer. Hey, good luck, buddy. You go to school for it and, work as sort of a white collar journeyman. No different than property management, right? Like, I mean, you want to hire people that have been doing it for a decade plus, who've sat at the leasing table, who's lived that life for 5, 10 years, and you can look at a set of financials and know what's really going on. Where somebody like myself, I mean, I guess I'm kind of smart with numbers, I can follow patterns. That's just not, I'm not going to have the heuristics that somebody who's been in the industry, just like a, construction engineer, or project manager. I mean, that was kind of the world I came from. There are things that I know about, building contracts, holding contractors accountable that, I kind of laugh and joke. You see these house flippers or some, Joe who doesn't have a professional job, number one, or maybe they're an accountant and they know numbers well, but they don't know the side of managing contracts, managing scope, schedule, budget, playing the game with contractors. And there's a reason why there's the word con in the contractor's name. But, I mean, I think some things you can learn, but some things I think you have to go through, learning it on the job. And that takes, a decade. And, I'm not a big fan of college, but I think college prepares people for this type of stuff. I'm a big fan of, if I had kids, I'd like to have them go work for BlackRock or something like that, or a property management firm for 6 months, not forever. But I think that a lot of that insight is invaluable.
Yeah, absolutely. And I think what you said there was that your aha moment came when you realized that people were coming on board as team members that knew a whole lot more about the industry than you.
Yeah, that's correct. That's correct.
Yeah, I think that's a fun place to be, and somewhere I think that maybe all of us, as we're scaling our portfolios and growing our companies, it's something that's somewhere we should be consistently shooting for, is bringing people on around us that are better at what better at this than we are. And I think it's a common myth. I think even myself at times I find it hard to believe that somebody else would want to come work with me that maybe is better at a certain section of this business than I am, and it's just not true.
Yeah. Well, I mean, there's a lot of people out there that are good number twos and number threes. They don't want to do all the marketing nonsense and the business development. There's also a lot of people who think that they can do that, but they're not. And they're good number twos and COs and operators. But I think the people who realize where they're good at, most times the entrepreneur, the founder is kind of just the good BS talker and the idea visionary. And they can't really put stuff together. But, those, I think at the end of the day, you need to kind of realize where you're at. I mean, the E-Myth is kind of a great book for that, to kind of understand working in your business, not on it. But, I mean, no different than the model that we use is just like a lot of, institutional private equity firms, guys with 10, $20 billion of assets under ownership. This is, you look at their rosters of employees, and that's kind of the blueprint.
Right. Yeah, absolutely. Absolutely. We talked about this off air, before we started recording here, and you said that you guys have kind of taken a pause on acquisitions for the moment. Can you give some insight as to why that is?
Yeah, I mean, I think no secret, the interest rates have kind of jumped up a little bit, and that will change your debt service coverage ratios a little bit. Definitely change your holding costs and how much you cash flow. Although I would, I tell investors all the time, like in this type of investing, we're not doing the buy, hope, and pray model. The buy, hope, and pray model, people who own little rental properties or, don't really do value add to their projects. The interest rate matters a heck of a lot. Even half of a point can take a huge chunk of your cash flow away. I mean, we're in the value add game, so it doesn't really matter too much. But, I think there's a lot of uncertainty. I haven't seen it jump up this. I mean, I've seen it jump up this much, but not like 2 to 3, months in a row, right? I think next month they're saying they're going to be a half a point. It all makes sense, right? They're using these quantitative, I think tightening is the right word, to ease off the inflation. It's a war on inflation right now. To me, this is exactly what the Fed is supposed to do to ensure that we don't go into a hard landing recession and we stay to this soft landing and off to the races for another 5 to 10 years right after this. But this is all intended. And what I look at is the unemployment. If the unemployment's pretty much at semi all-time lows right now, as long as that stays pretty healthy, we'll be fine and we'll come right out of it. But from our perspective, I mean, things are changing a little bit. So we decided to take a little bit of a break. And we've been pretty heavy buying stuff since the year 2020 in the pandemic. And I think that year really set us apart. We're when a lot of people just like fell off the mat because they couldn't close deals. I think that's what really established us and powered us through 2021 and 2022, where we were making acquisitions, I would say every other month, some kind of a deal. And that really got us up to the top of the list with a lot of brokers because we were active during those times. So part of it is personally want to take a little bit of a break, a little bit for maybe a month or several months and just see how this, sloshes through the system. Although right now there is a little bit of a buying opportunity. A lot of the larger institutions, the guys, who own over $5 billion in assets under ownership, the big sharks that control most of the money and most of the markets, they've kind of pulled back just like how we have. And part of it is, I was kind of copying what they were doing too. But they'll eventually come back because they have to, right? That's how these big institutions make money, by just placing the money, which should make most people sick to their stomach hearing that, but that's the reality. But they'll come back in maybe in the next month or two, and then that will put things right back into the general sellers market that we are in. I still believe we are still in, but there is a little bit of buying opportunity. But that's kind of where my head's at with the whole multifamily market.
Yeah, I like that, and yeah, I do see that there's a slight. I mean, I think anytime it's like I don't know, it's like coming up for air. It's like, oh, hey, any air is good air, and so people, when they see a slight softening in the market, like, oh, maybe it's becoming a buyer's market. Well, maybe, but we've got a long way to go before this becomes a real. Yes, there may be buying opportunities, but I don't think we're anywhere near a buyer's market yet. I think we got a lot of places, or a lot. It's got to get a lot worse before this becomes a buyer's market. Tell me about
a little vacuum, buyer's market vacuum within the seller's market, essentially.
Yeah, I think that's actually a great way to put that. I really like that. You guys are focusing. I know you said you're not doing anything necessarily on the value add multifamily. Are you guys doing development? Are you guys doing? I mean, what else are you working on then? If you're not buying multifamily properties right now?
Yeah, I mean, our general trend was to kind of get into larger projects. As I mentioned, we started to do a lot of smaller Class Cs, 50 units, 100 units when we first started. A lot of those tenants, I mean, you can make a lot of money in that type of stuff, but it's a real headache because your collections are way worse than their Class B or A tenant. And that ultimately is, for passive investors' perspective, they don't give a rip, right, about that. That's my problem. But I care a lot. If the juice is not worth the squeeze, I don't really want to do it. I'd rather just do Class B and, have it be a little bit smoother process and have distributions come out a little bit more consistently, which is why we've tried to, fight towards, larger Class B assets, larger deals. And then now, especially where, things are kind of going these last several months, I would say like late last year, we bought like a deal for like 89 grand and now it's worth like 120 for no good reason. I mean, it's just market appreciation and it just seems a little silly to be buying it at that price. And it's starting to get to a point. I mean, it has been getting to a point where like the debt service coverage ratios aren't where it was. We don't have as much fat there.
Right.
So this is just the whole all tides are rising on boats. So from my perspective, it makes sense to get on the train of more heavier value add where you have more deeper margins. You have to build the thing, which is an expertise that a lot of people don't have. I mean, that's what I went to school for as a construction management civil engineer. It's just a matter of bringing in the right professionals and getting up to a large scale to be able to pay the right professionals to do it. So I think that's what one of a misnomer a lot of people have is development. And development is just pulling the deal together, but it's actually the construction element part, getting the architect, getting the construction management, putting it all together, managing it, and fighting every day with the contractor to get it built on time, on schedule, on budget. Now that's the hard part. But if you hire the right professionals and you have enough budget, right? That's the other key thing. I mean, usually a capital raise of over $5 to $20 million in that range is what you need to have an adequate budget to go after it. So you're not building a little 50 unit property. Usually you got to go bigger, over 200, 300 units. And then you can go to this certain scale. And that's kind of that shelf. So it's always like this kind of constant swimming upstream to find locations or areas where there's less competition, less people doing it, and larger margins. It's that whole concept where the air is nicer up at the top of the mountain because there's less competition around. And the nice thing about development is you don't really have to worry about little undulations in the market, bumps along the road. You just build it. You just raise all the capital up front. You build it, and you're kind of in a vacuum for 2 to 3 years that you're building it. And even if you come out in a horrible time, I mean, in theory, you should have enough. You should be building it for such a price where you would like have so much margin. And another thought too is, like the price that you're paying for these Class B units. I mean, like you can build that stuff brand new. You just have to go through the headache of building it. And then now you have a brand new property that is like 30, 40, maybe even 50 years. You have that much length and runtime. So that thing degrades to a Class B for that same price. I mean, when you look at it from that perspective, I mean, it just kind of it's a no-brainer. But the hard part with this whole model is the land. The land to buy this stuff in the right places is very difficult, much more difficult than find that amazing deal of, 100 unit Class B, C property. It's a lot harder. And then you have to kind of, a lot of times the general partners have to put up all the money for the land purchase. There's a little bit, your general partners need to be a little bit more higher net worth to be able to cover that. But that's another, we've kind of opened things up, right, to hit other pitches instead of just swinging at Class B, multifamily, and B plus areas in the Sunbelt. It's like if you're only waiting for that inside pitch right above the belt, there are other good pitches that you might be able to do something with.
Right.
Use the baseball analogy.
Right. No, I love that. And development is certainly, I mean, I've heard that from a lot of people who come on the show that are developers are like, hey, this is why we play here. And they've said the same thing you've said, which is that the reason we develop is we can build for less than what we can buy, 20 or 30-year-old stock for, even after we value add. We can still develop it for less than that. One of the things we saw in 2007, 8 was that I remember just driving by project after project or project, half built. They ran out of funding. The credit lines dried up. Half built projects. Do you see any fear of that? Same scenario repeating itself if we do go into a deep recession?
Yeah, it's a good observation. So what's happening there is these bozos aren't going in fully capitalized for the entire build, which is a common practice of larger institutions. They run very lean, I think too much at risk type of their cash flow model. So we actually have like next to one of our in progress builds, we have like another institutional run. They're a hell of a lot slower. But what they do too is like they start to open up their facility in phases. They won't build the other half or third until the first half is open, creating cash flow. They use that cash flow to buy materials for the other one. It makes sense from like a large, institution point of view. You don't have these huge overlays of cash and it's not sitting for 3-4 years. But I mean, as the general partner, I mean, I don't want my ass hanging out there, and not have something built, because guess who's going to have to take the recourse for that? Because it sure as heck it could be the passive investors, right? They ain't going to pitch in and do capital calls for that kind of stuff,
right?
And that's why, I mean, selfishly, but I think this is more conservative. You go in with all the money you need up front for the build. You get your bank loan for the whole thing. And then you build it. It's a very rare circumstance that the construction loans will be frozen, which happened to some people in 2008.
Yep.
But I know what you're talking about, because they're all over the place. To me, I mean, every situation is different, but most of those was a byproduct of they just didn't have all the capital raised up front. And that it's a common practice.
Sure. And it sounds like your way of getting over that is just raising the capital up front and just acknowledging that, hey, we're going to raise it all up front, and that cash might be sitting idle until you need it. But it's almost its own insurance policy. So if you look at it, the cost of capital sitting idle, it's like, well, that's not really, it's just that you're just paying insurance, so that you have the money when you need it.
Yeah. I mean, if people want to go do their own deals and, do it, I'm sure you can pump your IRRs up by not having that capital just sitting there, but good luck. Do it yourself, then. Right.
Yeah.
To me, even if you raise all the capital up front, I mean, for a development deal, I mean, for the sort of perceived more risk than going into a stabilized asset, I mean, you better be doubling, tripling your money in that time or better.
Right.
But I'm sure the way these other guys do it, where they raise their money in a just-in-time format, I mean, I'm sure they're technically hitting like a IRRs of the 40s to 50% plus land, but like, really, do you need that? If you need that, go invest, go gamble on some altcoin crypto. I mean, the reason why we invest in real estate, because it's a hard asset at the end of the day, provides income, and it's stable.
Right.
I mean, this is not like a get rich quick scheme. This is have your money, get your money on the table and have it work for you, but you don't have to worry about the damn thing losing money.
Right. Right. You said it, man. You said it. Lane, I've enjoyed having you on the show today. Thank you for taking the time to come on and share with us your insights on the market, what you guys have been buying, how you guys are doing things differently, how you are, dealing or doing some developments and things right now that maybe are a little bit different, and even then also on how to protect yourself in a development, in a changing financing environment. So it's been a lot of fun to have you on. Certainly appreciate it and have enjoyed it. Tell me this, if our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Yeah, they can check out my website, simplepassivecashflow.com. And then if you're interested in connecting, my email is lane@simplepassivecashflow.com.
Awesome. Lane, thank you again. Certainly appreciate it.